Okay, students, we ended the first video talking about stockholders' equity, and we're down to these common stock transactions. But first, they talk about the stockholders' equity section of the balance sheet. And the stockholders' equity section has four main elements to it. First is contributed capital. Now, that's the money that the assets that the owners have directly contributed. Now, up until now, when owners contributed capital, when they bought stock initially or at some other point, we just debited cash, credited common stock. It's actually a little bit more complicated than that, and we'll get into that accounting in a little bit. But right here, this is the amount of capital the company receives from investors' contributions directly. It represents what's commonly referred to as paid-in capital or contributed capital. Okay, it can have several components involving several accounts. So they talk about common stock and preferred stock. There's also an account called additional paid-in capital, but those are all parts of contributed capital. Now, the second part is retained earnings. And you got to remember those two words. So earnings means net income. Retained means we kept it. Now, if we didn't keep it, what did we do? Well, we got rid of it. How do we get rid of earnings? Well, we pay them as dividends. So retained earnings is all of the earnings or all of the net income that the corporation has earned that has not been paid out to the owners as dividends. Now, the way they say it here, it's the cumulative amount of net income earned by the company less or minus the cumulative amount of dividends that they have paid out since the corporation was first organized. Retained earnings represents what's called earned capital. Now, contributed capital accounts and retained earnings normally carry credit balances. Now, is it possible for retained earnings to have a debit balance? It is possible. It's not common. But usually when it does, rather than retained earnings, it's called accumulated losses. And the way you have negative retained earnings is if you've had losses, at least recently, that have eroded any retained earnings and now have you in a situation where your accumulated earnings are less than the amount of your accumulated losses plus accumulated dividends you might have paid out in the past. So not very common. Treasury stock is a contra owner's equity account, meaning it carries a debit balance. Now, you will probably think it's an asset when you hear me describe it, but it's not. It's a contra owner's equity account. Now, treasury stock are shares of a corporation's own stock that they have actually bought back from owners and now hold within the corporation. So treasury stock is stock that has been issued. That means it was sold to investors and then it was bought back and is now held within the corporation. Now again, it's not an asset, it's a contra owner's equity account. It's reducing the amount of owner's equity that the owners have. Accumulated other comprehensive income or loss is the fourth category of elements that are in the owner's equity section. And it has to do with increases in the value of certain investments that have not yet been what we refer to in accounting as realized. So you see right here, unrealized gains and losses. Now, what realized means is gains or losses are realized when we have converted them to cash. So certain types of investments, if they go up in value, we value them at their current value, or what's referred to as fair value. But we don't recognize those increases or decreases in value in net income. Instead, it goes into the owner's equity section as other comprehensive income, and that's a temporary account. Then it gets closed out to accumulated other comprehensive income. So also gains or losses on investments that are held in things like pension funds quite commonly go into accumulated other comprehensive income or loss. We won't talk a whole lot about this account. That's one we deal with in greater detail in intermediate accounting. Okay, let me move on down. And they get into some terminology related to stock. So the corporate charter sets out the maximum number of shares of stock that the corporation can issue. Now that's usually a very large amount, and that's what's referred to as authorized shares. Now, authorized shares just means the number of shares the corporation is authorized to issue. That amount can be changed by amending the corporate charter, but businesses don't like to do that very often because it's just an unnecessary step if you set the number of authorized shares very high at the beginning. Okay, issued shares is the number of shares that have been sold outside the business at some point. Now, I talked about treasury stock a while ago. That's stock that the corporation issued and then bought back. So treasury stock shares are issued, but they are not outstanding. Excuse me there. Outstanding shares are shares that are left standing outside the corporation. If you want to get a word picture there, think of outstanding shares as here is this big building that's the corporation, and those shares are out there on the street. They're standing outside the corporation. They're shares that have been issued and are still owned outside the corporation. So we have authorized shares. That always has to be the biggest number. Now, some of these numbers could be the same, but none of these numbers can be bigger than authorized shares. That's the maximum number the corporation can issue. Issued shares are shares that at some point have been sold outside the corporation. Treasury shares are shares that have been issued but have been repurchased by the corporation. So they are issued shares, but shares that are now held inside the corporation as opposed to outstanding shares. Outstanding shares are those shares that have been issued and are still owned outside the corporation. So treasury stock and outstanding stock combine to total to issued stock or issued shares. Okay, so I hope that makes sense to you. And there you see it kind of drawn out for you. So we have 75 million shares authorized. Issued has been 50.6 million. And of those 50.6 million shares, 46.6 million are still outstanding and 4 million have been repurchased and are now treasury stock. So you see this number plus this number equal this number. That will always be true. Okay, now here they get into stock authorization and par value. Par value is, right here they say, an insignificant value. It's really a meaningless number, but it has certain legal aspects to it, but not very meaningful in this day and time. Most corporations being formed today set par value extremely low. 1 cent per share par value is not uncommon. So, but it's what's referred to as legal capital. And so if we issue shares, let's say we issue 100,000 shares of $1 preferred stock for $50 a share. So we raise 50 million shares. I think I said we issued 1 million shares. I said preferred stock, but doesn't matter what kind of stock, but we'll stay with preferred. So we issued 1 million shares of $1 preferred stock for $50 per share. Now, that would mean that $1 is the par value. So we're going to debit cash for the $50 million received. We're going to credit preferred stock, or if it had been common stock at par value. So that would be $1 million. And the other $49 million goes to another account we'll talk about down here, but it's what's referred to as additional paid-in capital. And that is contributed capital above and beyond the par value. So anyway, they explain a lot of that right in here. Read the book, read it to understand, but it's, again, par value is kind of a meaningless number today, but it is what we credit stock for when we sell stock and when we buy it back. Then it goes into treasury shares, and usually those are accounted for using what's called the cost method. And I'll explain that a little more when we get down to treasury shares. Okay, and right here, this is an important point here. Well, let me move up here first. They talk about par value. Sometimes stock is no par value stock. In that case, if it has, sometimes you have no par value stock, but with a stated value becomes equivalent to par at that point. But if you have just no par stock, then you eliminate the additional paid-in capital account. And when you sell the stock, you debit cash or whatever other asset you receive and credit common stock or preferred stock, whatever it is, at the sales price. Now, down here, good point. Don't confuse par value as it relates to stock with par value as it relates to bonds. With bonds, that's meaningful. We call it face value more commonly, but it's the amount the bondholders will be paid at maturity. So they are very different in their meaning and in how we account for them. Now they get down to stock issuance here. Talk about an IPO, or initial public offering. That's the first time that you offer stock to the public, and nothing really significant beyond that about it from an accounting standpoint. But when we sell stock, so what happened here, they issued 100,000 shares of 1 cent par value stock for $20 a share. So $20 times 100,000 gives you $2 million cash received. You're going to credit common stock at par value. So 100,000 shares at 1 cent par value would be $1,000. You'd put your decimal point right here. So we're crediting common stock for the 1,000, and then we would credit additional paid-in capital for the rest. Okay, there you have your journal entry. So my time's about up. I'll stop there, and we'll pick up there with the next video.